The U.S. economy just lost 92,000 jobs. Not gained. Lost. That is the first negative payroll print in years, and it dropped on the same day oil exploded past $90 a barrel for the first time since 2022. The market is in full panic mode. But buried inside this chaos, there are sectors that are actually set up to win big. Let me break it all down.
Going into this morning, the consensus on Wall Street was for about 55,000 jobs added. Unemployment was expected to hold at 4.3%, a modest number, but still positive. Instead, we got negative 92,000. The economy did not just miss expectations, it went backwards. That is a swing of nearly 150,000 jobs from what Wall Street was expecting. Unemployment jumped to 4.4%. And it gets worse. December's numbers were revised from positive 48,000 all the way down to negative 17,000. So we now have 2 negative payroll months out of the last 3. That is a pattern, not a blip. When you dig into the sector breakdown, the weakness is everywhere. Healthcare lost 28,000 jobs, mostly because of the Kaiser Permanente strike. Over 30,000 nurses walked off the job. Federal government shed another 10,000, on top of 330,000 federal jobs cut since October 2024. Manufacturing lost 12,000. Construction lost 11,000. Transportation lost 11,000. Information services lost 11,000. There is no single sector dragging this down. It is broad-based weakness across the entire economy. And here's what makes this even more complicated. Average hourly earnings still rose 0.4% month over month to $37.32. So wages are going up while jobs are going down. That is textbook stagflation territory. Weak growth plus persistent inflation. The worst possible combination for the Fed because they cannot cut rates to help the economy without risking even higher inflation.
So the jobs picture is ugly, but that is only half of today's story. Because while all of this was happening, oil was doing something historic.
West Texas Intermediate crude closed at $90.90 per barrel. That is a 35% gain for the week. Let me say that again. Oil was up 35% in a single week. That is the biggest weekly gain in the history of oil futures trading going back to 1983. The Strait of Hormuz, which handles roughly 20% of global oil consumption, has essentially been shut down. Qatar's energy minister warned that Gulf exporters could halt production within days and floated the possibility of $150 oil. Diesel prices have doubled in Europe. Jet fuel is up 200% in Asia.
So you've got a collapsing labor market and an energy crisis happening at the same time. How did the broader market react?
Badly. The Dow dropped 453 points to 47,501. The S&P 500 fell 90 points to 6,740. The Nasdaq got hit the hardest, down 361 points or 1.6%. But the real carnage was in small caps. The Russell 2000 dropped over 2%. For the week, the S&P lost 2%. The Dow lost 3%. Wall Street's worst week in months.
Now, here's where it gets interesting. In the middle of all this red, there are sectors that are actually thriving.
Number 1, precious metals. Gold is above $5,100 an ounce. Gold, tracking ETFs, were up over 1.5% on the day while everything else was falling. Weakening labor market, rising geopolitical risk, the possibility of rate cuts. Gold becomes the ultimate safe haven. Gold miners are reporting record profits because prices are elevated while production costs have not moved nearly as much. Number 2, energy producers. When oil goes from 65 to 90 in a week, every barrel these companies pull out of the ground is worth 40% more overnight. If the Strait of Hormuz stays disrupted, this could be a prolonged period of elevated prices, incredibly bullish for domestic producers. On the losing side, small caps broadly are getting crushed. Companies without strong balance sheets are most vulnerable. Regional banks are under pressure because the yield curve is bear steepening, squeezing their margins. Consumer discretionary is weak. Semiconductors sold off hard, though the AI-specific slice has an independent demand tailwind that is separate from the jobs market. The defensive areas holding up are classic low-beta names: tobacco, utilities, large-cap pharma. People do not stop buying medicine or electricity during a recession. Here's how I'm thinking about positioning. Precious metals and gold miners are the clearest beneficiaries. Energy producers benefit as long as the geopolitical premium persists. Defensive sectors offer stability. High-quality mega-cap tech with strong balance sheets can weather this. The areas I would be most cautious on are small caps, regional banks, cyclicals, and anything with thin margins that cannot absorb higher energy costs.
And the key thing to watch next week is CPI on Wednesday. If the oil spike is already feeding into broader inflation, the stagflation narrative is confirmed, and the Fed is truly stuck. If it is tame, there is a window for rate cuts, and risk assets could bounce hard. That is the next make-or-break data point. The economy lost 92,000 jobs. Oil just had its biggest weekly spike in 40 years, and the market is pricing in serious risk. But there are clear winners if you know where to look. Subscribe because we are all over the CPI data next week. I will see you in the next video.